Hey everyone, it's Rayce Robinson, your favorite Florida mortgage broker. And Fannie Mae just came out with their May housing economic forecast, and it was a doozy. They downgraded some of the numbers. So I want to go over those and what they're saying about the market here coming up over the next couple of years. I am fresh off of shoulder surgery, which is why I'm in the sling, working from home for the next 5 weeks. So as I get new data, I have plenty of time to go over that and how it's going to affect things. And I like to do all this from the lens of two things. One, that the weather's changing, meaning we've had one of the most red hot real estate markets of all time. And so things are going to change, right? There's going to be more inventory, rates are going up, economics have changed. We had a negative GDP growth in the first quarter. And so many things have changed, supply chain issues, inflation. So how's that, that change in that weather is going to affect housing and some of those things. And then always from the lens of evaluating, should I be buying? Should I be refinancing? What are the numbers that I need to be looking at? And so I deal with buyers every day that are looking at those kinds of questions. So let's look at what Fannie Mae is saying about really the market for the rest of this year and through 2023. This is the press release that they put out. You can see it came out on May 19th. The headline was "Rapidly Rising Rates and Persistent Inflation Further Soften Economic Outlook." And so I highlighted some of the parts that I thought were interesting. Persistent inflation, rising interest rates, and a slowdown of global economic growth are the primary contributing factors to updating the expectations that the full year 2022 real GDP will grow at the reduced rate of 1.3%, 0.8 percentage points less than previously predicted. So that's one of the numbers that they had changed. The ESR, which is the group that puts this together for Fannie Mae, latest forecast sees second quarter 2022 growth rebounding to 1.6%, following last month's contraction by 1.4% in the first quarter. Because the first quarter of this year, we had negative GDP growth for the first time in a long time. And to be in a recession, you obviously need 2 consecutive quarters of negative GDP growth. So Fannie Mae was wrong, and we printed a negative GDP growth again for this year, or for this quarter, then we'd technically be in a recession right now. And then they're saying the Fed's efforts to curtail inflation by tightening monetary policy are unlikely to result in a so-called soft landing. Expectations for a modest recession begin in the second half of 2023, remaining unchanged. I'm going to show you those numbers. Though the risk of such a contraction occurring sooner have increased as consumer spending power is increasingly constrained by elevated inflation and rapidly rising interest rates. And then they go on to say meaningful slowdown in home sales for the second and third quarter of 2022, following by a softening of construction activity and ultimately a large deceleration in home price growth, which we're also going to look at as well. With mortgage rates having risen faster in the last 5 months than in any period in 1981, I can attest to that. The expectations of both purchase and refinance originations to decline meaningfully, with only 1.4% of mortgages now predicted to have a 50-plus basis point incentive to refinance. Is expected that going forward, a majority share of refinance activity will be of the cash out variety. So that's a lot. So obviously what they're saying is with increased interest rates, the inflation and the slowing GDP, that is definitely going to curtail lots of things, housing being one of them. The Fed actually is trying to slow housing down some with increasing rates. And so you're going to see this big deceleration, as they call it, because you cannot have 20% appreciation year after year after year. It's just not sustainable. And so they're going to see that slow down, which we'll look at in a minute. And then, of course, they say that most of the refinances are going to be cash out, which makes sense, right? And people are not refinancing for lower rates. But it does make sense that people still refinance for cash out. We just looked at a couple last week and looked at a couple, really every week we're getting people calling us. And to fight inflation, one of the things you can look at, even if you increase your rate, we are taking people, we're wiping out all of their debt, sometimes giving someone, $1,000, $1,500 extra a month in income, or as far as less debt, so more expendable or income that they can use to pay bills and all those other things. So It's all relative to everyone's situation, but obviously there's going to be no incentive to refinance just to get a lower rate. And then they say here, rising mortgage rates are reducing affordability through higher mortgage-related costs, all while housing prices continue to grow, especially here in Florida, still red hot. Historically, rapid and substantial rise in mortgage rates have had the effect of slowing activity, which we've reflected in our forecast. Not only is the worsening affordability of homes a problem for potential entry-level home buyers, right? Really been tough for first-time home buyers to compete with all the cash deals. They just don't have the ability to compete with those offers. Also, affordability with the housing so high, with rates increasing so much, the average buyer is now, I did a video on this before from last year, in qualifying for about $40,000 or so less on a mortgage based on where rates are at now, where they would have been last year. And current homeowners are less likely to trade in their existing lower rate mortgages and list their homes for sale, both of which are likely to weigh on sales, which that actually impacts inventory, right? Because if I'm in that situation of I were to sell my house and buy another one, I've got such a low rate, I would actually, even if I just did a lateral move, I would have a higher payment. So that's also going to decrease the incentive of obviously sellers to list their homes on the market, which is all going to impact everything. So let's take a look at what Fannie Mae is actually predicting, and then I'll give you my thoughts on what's going to happen here in Central Florida. Okay, so here's the economic forecast. Let's start there. So you can see this is 2021, really, and this is GDP growth here. All positive numbers, all over 6% except the third quarter of 2021. So in the first quarter of 2022, we had negative 1.4 GDP growth. That's the first negative number in a long time. And so we did have a negative growth here in the second quarter of 2022. Then we'd be in a recession right now. Fannie Mae is predicting, and I've seen other places also predict this number, about 1.6% for GDP growth. And then they're predicting, you can see all the way here in the third and fourth quarter of 2023 to have negative 0.5 and negative 1.5. So that's where they're predicting the recession. Though they did say that, as things change, that could happen sooner, right? So those are the things that they're looking at and paying attention to with inflation and what the Fed does. That's all going to impact that. And then as far as their housing forecast goes, so these are a couple things that I want to look at. So first of all, Fannie Mae's home pricing index. So this is what they're predicting for home prices to do, which is, I think, everyone's big interest. So you can see here, first quarter, second quarter, third quarter, fourth quarter. I mean, these are just huge growth numbers. In the first quarter of this year, 20%. I believe that's a 40-year record. So that's super high growth. You can see they're predicting 15.9% growth in the second quarter 2022, 12.9, 10.8, and then we're going to get into 2023. You can see that by the end of 2023, they're getting to 3.2% home price growth, right? So very nominal appreciation at that point by the end of 2023. And then again, total home sales, you can see here just declining and basically getting, by 2022, negative 11% from 2021, and then another negative 11% in 2023. So I want to come back to this Fannie Mae Housing Price Index and kind of how I read this and what some of the clickbaity headlines are going to say that this means. If you're going 100 miles an hour and you slow down to 20 miles an hour, it's going to feel like you literally came to a crawl. But the fact is you're still moving forward. And most predictions that I've seen, if not all of them, are predicting for almost no depreciation. Now, does that mean that could happen? Of course, it could happen. But my point is, no one is predicting massive depreciation at this point. And those are numbers that we're going to pay attention to. You would need a massive amount of supply, kind of the converse of what we have right now. And there just isn't a lot of places for that supply to come from. But obviously there will be more supply, which is what Fannie Mae is predicting. So this comes down to so many people I know over the years have been waiting for the big crash or big pullback in the prices in houses. And the truth is, you may have to continue to wait. And I'm going to go back to you and link to the video down below that I did to Should You Buy a House in 2022. But ultimately, the reason to buy a house, investment property, any properties, you're taking either someone's rent money or the money that you would pay in rent, and you're paying your own mortgage down and creating wealth. At the end of the day, when you own a house, I've owned this house here for many, many years, whether it goes up or down in value, I'm still paying my own mortgage, and over long term, homeowners create more wealth. And so I said this in the last video, it's one of my strongest beliefs, is setting up your investing, whether it's in stocks or housing, trying to time the market and set up your investment strategy on a crash hardly ever works, because the crash rarely comes, and then you miss out. I have so many people that have missed out year after year after year, and now as the market slows down, you're going to see these headlines: market slowing down, rates going up, market decelerating, building inventory. Again, those have nothing to do with the market crash. Those just have to do with we've had record low inventory, record low rates, and now that pendulum is swinging the other direction. How far that pendulum will swing, truthfully, no one knows. No one can say 100%. But what I will say is what Fannie Mae is predicting is 3% growth by the end of 2023. That's what I kind of think will happen, is we're going to get a big slowdown in appreciation, really over the next couple years. I think the Fed is really in a bad spot with rates, because I think unemployment could start going up. If unemployment starts going up, then they're going to have a decision to make. Do they keep raising the Fed funds rate, or there's a lot of economists predicting that they're going to go the other way and start lowering rates again. And again, rates are not a good reason to not buy a house, because you can always refinance, and you would have missed out, many, many times. Like in 2006, rates were about 5%. So I'm going to keep coming back to this as I look at these videos and do these videos as the market changes, because it definitely is. And we get more inventory and all these things, that do not buy a house for appreciation. You buy a house for the long-term wealth that it creates. Yes, it was great, the appreciation for people that bought over the last few years, but in general, when you're buying a house, you're making a long-term commitment to that house. So with that, if you have any questions on this report, on the market, on interest rates, on programs, or you just want to work with a great lender, Google Rayce Robinson, see what people say about working with me. Call me if you have any questions, leave a comment below. Hopefully this is interesting to you. If you do, share it, like it, subscribe, all that good stuff. I'll talk to you soon. Bye-bye.